So what is the efficient market hypothesis and why does it matter? The efficient market hypothesis, or EMH for short, is one of the pillars of modern finance. On the surface, it's almost elegant. Markets are efficient, prices reflect all the available information, and no one can consistently beat the market. As a clean framework, it works beautifully, but elegant ideas rarely survive intact when they collide with reality. The EMH is less a scientific law than a useful assumption, a tidy model for a messy world. Markets are driven by human behavior, by patterns and shocks that don't always fit the theory, and the markets we face today are no exception. So let's explore 3 common misunderstandings about the EMH and why this matters in today's markets. I first came across the efficient market hypothesis while working in financial journalism. That was fascinating because you got to see the full spectrum of financial thinking. On one side, you had the motley fool, constantly encouraging readers to use their knowledge to beat the market, which I loved. On the other side, the financial advice industry, which was mostly people pushing managed funds while charging fees for advice you could find anywhere. So when I first heard this idea that markets already reflect all information, that you can't beat them, and your only real option is to wait decades for long-term returns, I hated it. Not just because it killed the fascination I had with trading, but because it didn't match what I saw in the real world. Look at actual market data. Prices don't always move in some smooth, rational flow as new facts arrive. You get long quiet periods, then sudden storms of activity where risk clusters together in time. They spike, they plummet, they stall. Volatility doesn't stay steady, it comes in bursts. Before we go any further, let's take a step back and look at what the EMH actually says. At its core, it claims markets are informationally efficient. That means prices reflect all available information. So in theory then, you can't consistently beat the market just by being clever. There are different forms of the EMH. The weak form says prices already capture all past trading information, meaning technical analysis, chart patterns, momentum strategies should all be useless. The semi-strong form says prices reflect all public information, like earnings reports, news releases, economic data, that kind of thing. And according to that, even fundamental analysis doesn't give you an edge. And then there's the strong form, which is the extreme version, which says markets reflect even insider information. But that's more of an extreme view than widely accepted belief, but it shows how far the theory stretches. The first thing to note is how convenient the EMH is. It neatly justifies the rise of the managed fund industry. If you believe markets are efficient, then you shouldn't waste time trying to pick stocks. Instead, you should just buy the market through an index fund and hold it for the long term. That's a powerful message for fund managers because it essentially validates their entire business model. It tells investors not to look for skill because skill is irrelevant. Instead, investors should put their trust and their money into the system itself. In that sense, the EMH functions as a kind of intellectual comfort blanket. A lot of the time, though, it is a reasonable approximation of how markets work. So there's not too much to be worried about in doing that as particularly a retirement fund. But if you're making an investment intended for a shorter than 10-year time frame, this story can start to come unstuck. However, the real world is far messier than the textbooks suggest. Volatility clusters in time. Bubbles inflate and burst. Crashes happen faster than most investors can react. These aren't outliers, they're built into the very fabric of markets. Think of the dot-com bubble, when billions were poured into companies which had no profits or viable models, only for the whole thing to collapse overnight, or the 2008 financial crisis, where ratings agencies and banks and investors all assumed that risk was already priced in. However, When that groupthink broke, the system nearly collapsed. More recently, meme stocks like GameStop and AMC showed how social media and hype alone can move billions in days, with prices soaring far beyond the fundamentals. Volatility in these cases wasn't tied to information or value at all. It's true, over the long run, markets certainly do even out, but the fallout from these episodes lingers for years. The rise of cryptocurrencies reflects that lingering distrust. Bitcoin, for instance, has no underlying fundamentals, in theory, yet its wild swings are a reminder that chaos, not efficiency, often dictates market behavior. Famous investor Charlie Munger has made the point really well. He calls the efficient market hypothesis roughly correct for the average investor, but warns that extreme devotion to it is just bonkers, in his words. I tend to agree. The EMH is a simplifying assumption, not a law of nature. The messy realities of chaos in human behavior shape markets far more than tidy mathematics ever could. So what kind of things are ignored by those devoted to EMH theory? First, unpredictability doesn't necessarily have to imply that market information efficiency actually exists. Chaos, complexity theory, and irrational human behavior can all drive uncertainty as well. Prices only reflect information when investors actually act rationally, and irrationality is common. That's often where opportunities appear. Most of the time, it's hard to predict exactly what markets will do, but that doesn't mean that you can't spot undervalued stocks or bubbles or situations of groupthink. Secondly, the EMH implies that no one can consistently beat the market. And yet, history might suggest otherwise. Warren Buffett, Michael Burry, Peter Lynch, Nassim Taleb, and Jim Simons with his Renaissance technologies have all consistently, and that's the key, consistently outperformed the market or challenged or shown flaws in the prevailing wisdom. Their strategies can be risky and aren't for everyone. And obviously you should always check with a professional before you invest. But the fact that they succeed at all shows that the EMH claim is somewhat overstated. Thirdly, the EMH ignores how volatility and trends actually behave. Risk isn't a steady hum. It clusters in time. Charts and data have real value for that reason, something the EMH tends to underplay. For example, if risk is related to volatility, and volatility is clustered in time, which we can see that it is, then you need to look at past price charts to know what volatility is currently doing. Future events simply aren't independent of past events, even if most of the time they are unpredictable in the strictest sense. Markets also trend over time, and understanding those trends for both markets and individual stocks is very useful. That's how we know stocks deliver the highest returns in the long run, because we chart the data and draw conclusions from that. So the EMH is often presented as a neat, law-like theory and is widely taught as a baseline for understanding markets. But thinkers like Benoit Mandelbrot and Nassim Taleb, who are widely considered geniuses, challenge this conventional thinking, showing that complexity, chaos, and nonlinearity are central to unpredictability. Here I've just tried to point out that we can't treat this theory as some sort of natural law, especially if we are attributing unpredictability simply to informational efficiency. But rather, reality is a bit more complicated and just a bit more difficult to pin down.